A pleasant day, everyone. I am Jandal Hill D. Sarto, and along with my fellow groupmates, we will be embarking on a new chapter in the world of investment and portfolio management, specifically tackling portfolio performance evaluation. So sit back, relax, and listen well because this topic will be crucial as we endeavor in our field as financial management students. To start off, let us first recall what is portfolio performance evaluation. Portfolio performance evaluation is the last step in the process of portfolio management, and it involves the determination of how a managed portfolio has performed relative to some comparison benchmark. This is the stage where we examine to what extent the objectives has been achieved because through portfolio evaluation, the investors will be able to find out how well the portfolio has performed. Equally important to emphasize also are the objectives behind this, and we were able to sum it into three purposes. First is that portfolio evaluation will help you protect your earnings from market volatility. Second, it will enable you to create wealth through capital appreciation. And lastly, it will enable you to maximize your returns on investment. To further give us an overview, let us first watch this clip on portfolio management.
Portfolio management involves selecting, prioritizing, and controlling the projects and programs needed to deliver an organization's strategic objectives. It gives you a bird's-eye view of the range of work an organization is doing to deliver the strategy and uses this view to inform decisions. For many organizations, all the significant change work that's happening is brought together in one or more portfolios, used to inform strategy, balance risk, and spot gaps. Good portfolio management involves having the right balance of programs and projects to deliver the strategy and being clear on priorities so that effort and resources are allocated correctly. It also involves evaluating their value and how effectively they're delivering against the strategy to justify the investment. If an element isn't contributing to the strategic aims, directly or indirectly, it should be reconsidered and potentially stopped altogether. Portfolios enable you to manage the overall risk of a series of activities, having a mix of some projects that are very risky and others that are more certain, and making informed investment decisions accordingly. Managing a portfolio isn't just about existing work. It also involves identifying opportunities for investment and gaps that need to be filled with new work in order to deliver the organization's strategy. When you understand what's driving a business, you'll have a better sight of what the portfolio should deliver. Portfolio management enables an organization to get the most from its resources, to identify the projects and programs that will bring about significant and desired strategic change.
So hi everyone, I am Kirsten Myrtle Sarmiento and I'll be reporting the dollar and time weighted return. So the dollar weighted return, also known as money weighted return, functions similarly to the internal rate of return in terms of measuring investment performance. It is derived by determining the discount rate where the present values of the cash outflows is equal to the present values of the cash inflows, in which the returns are weighted by the amount invested in each period. So the formula for the MWR is money weighted return equals cash flow 0 plus cash flow 1 divided by 1 plus initial rate of return plus cash flow 2 divided by 1 plus initial rate of return raised to the power of 2 plus cash flow 3 divided by 1 plus initial rate of return raised to the power of 3. And so on, where n is the number of period. However, because of the nature of the formula, the IRR cannot be calculated analytically and must be calculated through trial and error by using a software program like a spreadsheet or a financial calculator. So for the time-weighted return, if you're looking for a dependable way to keep track of how your money is performing, time-weighted return is the most common method to calculate the performance of an investment portfolio. It is considered geometric means of an investor's portfolio performance in which the return of each period has equal weight. This means that each return is weighted by the time that it was included in that evaluation period. In other words, the TWR is intended to compensate for the number of cash inflows and outflows made to your account. So the formula for the TWR is time-weighted return equals 1 plus R1 times 1 plus R2 times 1 plus Rn minus 1, where R is equal to the return in different periods. So for example, imagine you buy a second share of the same stock at the end of the first year and hold both shares until the end of the second year when you sell each of the shares for $54. So based on the given above, we may calculate the average return over 2 years using the discounted cash flow method by equating the present values of the cash inflows and outflows. So 50 plus 53 divided by 1 minus the return, which is R, equals 2 divided by 1 minus R plus 112 divided by 1 minus R squared, resulting in R, or the return, equals 7.117%. It is dollar weighted because the stock's performance in the second year when 2 of the shares are both held has greater influence on the average overall return than the first year return when only 1 share is held. So for the time-weighted average, R1 equals $53, which is the second share purchase, plus 2, which is the year, minus 50, which is the first share purchase, divided by 50, equals 10%. And R2 equals $54, which is the selling price, plus 2, which is the year, minus 53, which is the second share purchase, divided by 53, is equal to 5.66%. Finally, the time-weighted average return is 7.81%, as 1.10 times 1.0566 times 1/2 minus 1 is equal to 0.781 or 7.81%. Therefore, the dollar-weighted average is less than the time-weighted average in this example because more money is invested in year 2 when the return was lower.
Hi everyone, I'm Alfonso D. Pescalante Jr. First, I'll be reporting adjusting returns for risk and universe comparison. Evaluating the performance of a company based on average return alone is not very useful. As a matter of fact, returns must be adjusted for risk in order to be compared meaningfully. The most common way to adjust returns for risk is to compare the portfolio's return with the returns on a comparison universe. For example, a high-yield bond portfolios are grouped into one universe, while gold stock equity funds are grouped into another universe, and so on. The usually time-weighted average returns for each fund within the universe are ordered, and each portfolio manager receives a percentile ranking depending on a relative performance with the comparison universe. For example, the manager with the ninth best performance in a universe of 100 funds would be the 90th percentile manager, which means that he/she had performed better than 90% of all competing funds over the evaluation period. Figure 24.1 summarizes the performance of the following periods: first quarter, first year, 3 years, and 5 years. The top and bottom lines of each box represents the 95th and 5th percentile managers respectively. The 3 dashed lines represent the rates of return of the 75th, 50th, and 25th percentile managers. The diamond is drawn at the average return of a particular fund, while the square is drawn at the return of a benchmark index.
After establishing the rationale behind the time and dollar-weighted returns, along with the adjusted risk returns, let us now move on to risk-adjusted performance. To give a background, we must first know that methods of a risk-adjusted performance evaluation using mean variance criteria came on stage simultaneously with the capital asset pricing model. There were 3 well-known individuals: Jack Trainer, William Sharpe, and Michael Jensen that was able to recognize the implications of the CAPM for rating the performance of managers. Within a short time, academicians were in command of a battery of performance measures, and a bounty of scholarly investigation of mutual fund performance was pouring from ivory towers. Shortly thereafter, agents emerged who were willing to supply rating services to portfolio managers and their clients. Furthermore, it is important to remember that though widely used, these risk-adjusted performance measures have their own limitations. So what are these possible risk-adjusted performance measures for a portfolio? First, we have the Sharpe measure, otherwise known as the reward to variability ratio developed by William Sharpe. Sharpe's measure divides average portfolio excess return over the sample period by the standard deviation of returns over that period. It measures the reward to total volatility trade-off. The ratio is the average return earned in excess of the risk-free rate per unit of volatility, where volatility is a measure of the price fluctuations of an asset or portfolio. Basically, it adjusts a portfolio's past performance or expected future performance for the excess risk that was taken by the investor. Through this, it will enable investors to understand the return of an investment compared to its risk. On the other hand, is the Trainer ratio, or also called the reward to volatility ratio, developed by Jack Trainer. Like Sharpe's, Trainer's measure gives an excess return per unit of risk, but it uses systematic risk instead of total risk. It is a performance metric for determining how much excess return was generated for each unit of risk taken on by a portfolio. Moreover, it allows investors to adjust a portfolio's returns for systematic risk. A good indicator of the Trainer ratio is that if it is higher, it means a portfolio is a more suitable investment. And lastly, the Jensen ratio, or also known as the differential return, is the average return on the portfolio over and above that predicted by the CAPM. Given the portfolio's beta and the average market return, Jensen's ratio is the portfolio's alpha value. For example, if two mutual funds both have a 12% return, a rational investor should prefer the less risky fund. Jensen's measure is one of the ways to determine if a portfolio is earning the proper return for its level of risk. In a nutshell, the Jensen ratio measures account for the risk-free rate of return for the time period.
Now I'm going to discuss the information ratio. The information ratio measures the risk adjusted of a financial asset or portfolio relative to a certain benchmark. Thus, it divides the alpha of the portfolio by the non-systematic risk of the portfolio, called the tracking error. It measures the abnormal return per unit of risk that in principle could be diversified away by holding a market. The information ratio and the Sharpe ratio are similar since both ratios determine the risk adjusted of a security or portfolio, but the information ratio measures the risk adjusted returns relative to a certain benchmark, while the Sharpe ratios compare the risk adjusted returns to the risk-free rate. The ratio aims to show excess returns relative to the benchmark, as well as the consistency in generating the excess returns. The information ratio is essential due to the following reasons. First, the information ratio is a performance measure used by fund managers. Second, it is essential in comparing a group of funds that has similar management tactics. And lastly, it provides insights about the ability of a fund manager to sustain the generation of excess. The information ratio is calculated by dividing alpha p and the standard deviation, or average return minus average benchmark, then divided by tracking error.
Good day everyone, this is Chorizo Camera and I'll be telling you about the enhancement of the previously mentioned Sharpe ratio. And it is the M-squared measure, which is also known as M-squared risk adjusted performance ratio. M-squared measure is named after the Nobel Prize winner Franco Modigliani and his granddaughter Lea Modigliani. Hence the dub M squared for Modigliani squared. Like the Sharpe ratio, the M-squared measure focuses on total mortality as a measure of risk, but its risk-adjusted measure of performance has the interpretation of a differential return relative to the benchmark index. M-squared measure is much more complicated than Sharpe ratio because it does not only rank two different stocks in order of preference, but it also lets us know how much better one stock is compared to an underlying benchmark, but in risk-adjusted percentage terms. M-squared measure helps in knowing that with a given amount of risk taken, how much the portfolio will reward an investor in terms of the risk-free rate of return and benchmark portfolio. To compute the M-squared measure, we imagine that a managed portfolio or P is mixed with a position in T-bills so that the complete or adjusted portfolio matches the volatility of a market index such as the S&P 500. For example, if the managed portfolio has 1.5 times the standard deviation of the index, the adjusted portfolio would be 2/3 invested in the managed portfolio and 1/3 invested in bills. The adjusted portfolio would then have the same standard deviation as the index. That is, if the managed portfolio had lower standard deviation than the index, then it would be leveraged by borrowing money and investing the proceeds in the portfolio. Because the market index and portfolio have the same standard deviation, we may compare their performance simply by comparing returns. The M-squared measure's simple form of formula is shown above.
Good day everyone. I'm here to discuss analysis on which measure is appropriate. Which measure is appropriate to use? It depends on investment assumptions in the portfolio. Number 1. If the portfolio represents the entire risky investment, then use the Sharpe measure. The Sharpe ratio adjusts a portfolio's past performance or expected future performance for the excess risk that was taken by the investor. A high Sharpe ratio is good when compared to similar portfolios or funds with lower returns. Number 2. If the portfolio is one of many combined into a larger investment fund, use the Jensen or the Trainer measure. The Trainer measure is appealing because it weighs excess returns against systematic risk.
The use of quadratic programming for the purpose of determining a fund's exposures to changes in the returns of major asset classes is also known as style analysis. Style analysis was introduced by Nobel laureate William Sharpe. Sharpe's idea was to regress fund returns on indexes representing a range of asset classes. The regression coefficient on each index would then measure the fund's implicit allocation to that style. Because funds are barred from short positions, the regression coefficients are constrained to be either 0 or positive and to sum to 100% so as to represent a complete asset allocation. The R-square of the regression would then measure the percentage of return variability attributed to style or asset allocation, while the remainder of the return variability would be attributable either to security selection or to market timing by periodic changes in the asset class weights. So in simpler terms, it is the process of determining what type of investment behavior an investor or money manager employs when making investment decisions. So as almost all investors adhere to some type of investment philosophy, a careful examination of a money manager's style is required before an investor can assess whether the manager is a good fit for his or her particular investment goals and preferences.
In section 24.8 on performance attribution, we show how portfolio managers attempt to uncover which decisions contributed to superior performance. This performance attribution procedure starts with benchmark allocations to various indexes and attributes, performance to asset allocation on the basis of deviation of actual from benchmark allocations. Performance evaluation has two very basic problems. Number 1. Many observations are needed for significant results even when portfolio mean and variance is constant. Number 2. Shifting parameters when portfolios are actively managed makes accurate performance evaluation all the more elusive. Although these objective difficulties cannot be overcome completely, it is clear that to obtain reasonably reliable performance measures, you need to do the following. Number 1. Maximize the number of observations by taking more frequent return readings. Number 2. Specify the exact makeup of the portfolio to obtain better estimates of the risk parameters at each observation period. Attribution studies start from the broadest asset allocation choices and progressively focus on ever finer details of portfolio choice. The difference between a managed portfolio's performance and that of a benchmark portfolio then may be expressed as the sum of the contributions to performance of a series of decisions made at the various levels of the portfolio construction process. For example, one common attribution system decomposes performance into three components. Number one, broad asset market allocation choices across equity, fixed income, and money markets. Number two, industry choice within each market. And lastly, number three, security choice within each sector.
Your portfolio is simply all of your investments. That's it, really. If you have one investment account and that account holds some stocks, some mutual funds, and some bonds, then all of those together would be your portfolio. Portfolio management includes the following: understanding your goals, risk tolerance, and time horizon, selecting an investment or a group of investments that is in line with those overall goals, rebalancing your portfolio on a periodic basis, and reviewing your portfolio over time to monitor your progress towards those goals. A portfolio should ideally be well diversified. That means you don't have a large percentage of your portfolio concentrated into any one individual security. For example, if your overall portfolio is worth $10,000 and $8,000 is invested in the stock of just one company, that's very poorly diversified, with 80% of your portfolio invested into just one stock. If you are buying individual securities, it's generally recommended that no one stock represents more than 5% of your overall portfolio. It's worth noting that it's possible to invest in one fund and have a well-diversified portfolio. Some investment funds are designed to be a solution for investors looking for a one-stop solution in order to achieve a proper portfolio, and these funds may in turn hold thousands of different stocks and bonds from around the world. Another important portfolio management consideration is your asset allocation. How much of your portfolio is allocated to equities, fixed income, or other asset classes? By having exposure to multiple asset classes, when one asset class is moving down, another one may be moving in a different pattern, thereby reducing the overall portfolio fluctuation. Your asset allocation is also a big factor in determining the overall risk and return profile of your portfolio. Portfolio rebalancing is an important exercise to keep your portfolio's risk and return characteristics from drifting away from what your target asset allocation is. For example, we know that a 50% equity and 50% fixed income portfolio is going to be a fairly balanced portfolio with a moderate amount of volatility. But let's say that in the next year, the 50% equity component does well, and the 50% fixed income component does poorly. We might find that our new asset allocation has drifted to 60% equity and 40% fixed income. This allocation has a higher risk and return profile than a 50-50 portfolio. If we sold off some of our equity component to buy some more fixed income exposure, we could rebalance our portfolio back to 50-50 and keep it in line with what we are comfortable with. When it comes to portfolio management, if you aren't interested in applying all these principles yourself, or feel you don't have the time to do it, you can always choose investment options that do some or all of these steps for you. You can choose portfolio funds, you can use the Advice Direct platform for some assistance when you need it, or you can have Smartfolio do it all for you.
Indeed, portfolio performance evaluation is an important and critical aspect of the financial world, especially if you are an investor. As Naveed Abdali once said, "To be a successful investor, you don't need to take excessive risk and be involved in all sorts of financial instruments. You just need to understand your risk appetite and a few asset classes well. Stay within your boundaries and your wealth will grow at a decent pace. Thank you for listening, and we hope that you were able to learn more in today's chapter on portfolio performance evaluation.